In one of my earlier videos, I talked about some holding patterns and what that meant for the crypto market. I touched on that in my most recent update, along with some other metrics, and I'm sharing those here in this video. If you like this video, give it a thumbs up and share it with people you know. For a long time, we've looked at the number of new addresses. It was a big downtrend from October of last year to really around the spring of earlier this year into the summer. That downtrend has ended. We broke this trend earlier this year. Haven't quite established an uptrend yet, but you can see that's kind of the direction it's going. But the downtrend is broken and it's starting to grow a little bit, a little slight uptrend, which is good. We want to see this metric rise. It signals new interest in the Bitcoin network, not Aunt Sally and Uncle Morton buying the ETFs, traditional investors, institutions buying into funds, existing users messing around with ordinals or whatever. But new addresses from people who engage directly with the blockchain, people who engage directly with the blockchain, they tend to stick around more. And that's one of the things we're looking for is that sticky money, that healthy churn, sticky money. People come in and they show some signs that they want to be here, not just they're here to sell as soon as the price goes to a certain amount. I mean, and they will, but like there's something more or grander that will keep people connected to the market. And those are all the metrics we look at for a very long time. You look at the estimated leverage ratio. This is the proportion of, it's basically the amount of gambling relative to the number of Bitcoins on exchange, how much money is being leveraged for quick gains and losses. As leverage goes up, more traders are more likely to get zapped with long squeezes, short squeezes. They take the wrong side of the trade. They're on leverage. So when when the market moves against them, they have to unwind and the higher the leverage ratio, it means more of that money is chasing a smaller number of Bitcoin. So it has more of a push on the price or pull on the price. The market moves higher or lower quickly without substantially changing the direction. So the swings feel really intense, but they just basically reflect bad luck. They resolve within days. Everything goes back to normal. It's important to know that because as long as this metric remains elevated, you have to prepare for sudden shifts in the direction of prices up or down, and they could come out of basically like out of nowhere. It's just the market responding to the circumstances. Other metrics look about the same as they did in previous updates, but one of the things that I think is important to point out, let's look at some of the behaviors, one dimension of behavior for people who bought the peak earlier in March, February, March, April, that time frame. Intuitively, you would expect these people who are buying the peak to stick around. They bought expecting higher prices. Bitcoin's price never went down far enough for long enough to get them to change those expectations. But you want to confirm that. And one way we can confirm that is by looking at the realized cap hodl waves. It's just a normal hodl waves. It looks at all the Bitcoins that have been held since, in this case, 3 months to 6 months and 6 months to 12 months. Haven't moved. And this weights that by the value of that, by how much each Bitcoin's price has changed. So it's like weighting it so you see the relative importance of the proportion of just how much influence that has on the market as they move. And these bands are growing as a group, they're growing combined. You might say, well, the 3 to 6 months went down and the 6 to 12 months went up. That's very normal. It's healthy churn. I've talked about that in previous updates. Once this band starts to shrink, then we can get a little cautious. But right now, it's fine. The people who bought all this, they're still here. They're still around. They're still cool. They're chilling. Some of them are up, some of them are down. A lot of this metric covers these people. You can tell from the way it's moved up and down and then spread over. It does include still some of these people who bought at much lower prices towards the end of last year. A lot of it is weighted towards people February, March, April, May. These people, generally speaking, they bought the top. They are the least committed to this market. They are the most likely to sell when price goes a lot higher or a lot lower. But for now, we see strength and conviction from this cohort. Once this band starts to shrink, then we'll flag that. Not now, and we'll keep an eye on it. The other important, well, I mean, they're all important, but another important part of the market are the OGs, the so-called diamond hands. People have held for years, in this case, more than 3 years. Everybody, they're all up a lot. I shouldn't say that. Most of these people are up quite a bit. Yeah, there are probably a few who bought at the peak in November 2024. But we know from the churn that and the changes we've seen over the years since then, that a lot of those people, they sold. They're out of the market. So what remains are people who legitimately have held for years and years and years. And this group, it's growing. It's going up. And a lot of this rise is 3 to 5 year holders, which is this part. I mean, it's everything, but at 3 to 5 years. These are the strongest. These are the most committed people. Diamond hands. They'll turn to paper hands if the price goes high enough. But these are the people who really form the foundation of the market. They're the strongest, they're the most committed, and when they start peeling out, then we start to worry, but we don't see that, so we don't have to worry about it at all. You might be wondering, well, Mark, I see other people flash the HODL charts all the time, and they don't look anything like this. It's just a different rendering. The other HODL charts will never reveal this behavior. Those charts, they just look at the total number of Bitcoins within a certain age range. And that includes 4 to 6 million lost Bitcoins. You would need to see hundreds of thousands of Bitcoins move before, on the other chart, you see any changes. But with the realized cap HODLways, we don't worry about the ones that don't move. We don't worry about the ones that lost. This one distills just those Bitcoins that move and actually have an impact on the market. The non-move Bitcoins, they don't appear. Bitcoins that don't move, they don't have an impact on the market anyway. This chart ignores those. The other charts includes those. That's why you get a little bit of a different result. The rest of the update talks about a Solana and Ethereum trade, a crucial trend in the US dollar, altcoin analysis, and some perspective about what to expect in the coming weeks. You can use the link in the description below to see that. Relax and enjoy the ride.